Welcome to our comprehensive look into return on capital. In today's video, we'll break down what return on capital is, why it matters, and how you can calculate it leveraging real-world examples. Whether you're a seasoned investor or a complete novice, you'll gain valuable insights to help enhance your financial acumen. Let's get started. To start, let's define return on capital, often abbreviated as ROC. Return on capital is a profitability ratio that measures the return an investment generates relative to the capital invested. Now, how do we calculate return on capital? The general formula is ROC equals net operating profit after taxes, NOPAT, / invested capital. Let's break down each component. NOPAT stands for net operating profit after taxes. It's a company's operational profit minus taxes, but excluding interest expenses. Essentially, it captures the profitability of a company's core operations. The next part we need to understand is invested capital. Invested capital refers to the total amount of money that shareholders and debt holders have invested in a company. Typically, this is calculated as total debt plus total equity, cash. Let's move on to a real-world example to solidify this concept. Imagine company ABC Inc. has a NOPAT of $500,000 and its invested capital is $2 million. Using the formula, ROC equals NOPAT / invested capital, we get ROC equals 500,000 / $2 million is equal to 0.25 or 25%. This means ABC Inc. generates a 25% return on its invested capital. Pause and think. What does a ROC of 25% tell you about the company? A 25% ROC means that for every dollar invested in the company, ABC Inc. gains 25 cents as profit. This is a key indicator of its operational efficiency. Now let's delve deeper with more examples. Suppose company XYZ has a NOPAT of $1 million and invested capital totaling $7 million. What would its ROC be? Using the formula ROC equals NOPAT / invested capital, we get ROC equals 1 million / 7 million, which equals approximately 14.3%. Great. Now you've calculated another ROC. But what does 14.3% indicate about XYZ? A ROC of 14.3% shows that XYZ is somewhat less efficient in converting its capital into profit compared to ABC Inc., which had a ROC of 25%. Visual aids can help solidify understanding. Here's a comparative bar chart of these two examples. Different industries often have different standards for what constitutes a good ROC. For instance, capital-intensive industries like oil and gas might have lower ROC compared to tech companies. Would you like an industry-specific example? Let's illustrate with a tech company example. Assume TechCorp Inc. has a NOPAT of $2 million and an invested capital of $5 million. Using our familiar formula, ROC equals 2 million / 5 million, which equals 40%. In the tech industry, a ROC of 40% is stellar. Now, let's examine a traditional industry, such as manufacturing. Assume Manufacturing Corp. has a NOPAT of $3 million and invested capital of $20 million. ROC equals 3 million / 20, 0.00000 equals 15%. Noticeably, despite a higher NOPAT, the ROC for Manufacturing Corp. is lower compared to TechCorp Inc. This is common as manufacturing usually requires larger capital investments. Next, we'll dive into how changes in capital invested or operating profit influence ROC. Consider a company that wants to increase its ROC. What actions can it undertake? To boost ROC, the company could 1. Enhance operational efficiency to raise NOPAT. 2. Reduce its capital base by selling off non-core assets. Or 3. Improve profit margins through strategic pricing and cost controls. Here's an interesting question. What impact do taxes have on ROC? Taxes significantly affect ROC since NOPAT is calculated after taxes, highlighting the importance of tax strategies. A company in a high-tax jurisdiction might face a lower ROC compared to one in a low-tax area. Time for a recap. We explored what ROC is, how it's calculated, and looked at examples from different industries. We also discussed strategies to improve ROC and the impact of taxes on it. By understanding and applying return on capital analysis, you can make more informed investment decisions and drive business performance. Stay tuned for more enlightening financial tutorials. Don't forget to like, subscribe, and hit the notification bell for the latest updates. Thank you for watching.